Well, we all knew a Trump presidency would result in a significant rise in headline risk, and here we are, with the markets trying to decipher tariff implementation and subsequent tariffs being put on hold. And after a few wobbles coming through in financial markets and a bit of volatility, we find ourselves with various equity markets in the developed market space looking at all-time highs again. We see volatility coming down a touch with the VIX trading at 15%. We're seeing US dollar sellers as we go into this week's important non-farm payrolls numbers. We're seeing gold at all-time highs. We're seeing crude under a bit of pressure. We've got a Bank of England meeting in the session ahead, which could have obvious ramifications for the pound. It's all going on. This is the trade-off. Well, hello. I'm Chris Weston, Head of Research here at Pepperstone, and we're joined in 2 seconds by Blake Morrow from Forex Analytics. And with all the different cross currents and the changes that we're seeing, which obviously pays to have an open mind about what's seeing and seeing what the collective in the market are thinking, I think we look at what's going on in the charts, the setups, the price, the movers and shakers, and try and decipher where the trades are in the short term. Anyway, I'm going to bring Mr. Blake Morrow into the programme. Blake, how are you going, my good friend?
What a great year 2025 has been. Never mind. It's only been a week since I saw you last.
I know. I feel like we're aging very, very quickly. But I think, we don't need to be surprised by what we're seeing. We all kind of knew what we were going to be seeing. The headlines coming through are interesting, shall we say, the least. But I think, the markets are trying to decipher exactly what's going on. And, we are seeing some big moves. But I think there's been some opportunities. And I think you need to continue to have an open mind about exactly what's going on, because I think that's the key for me right now.
There it is. I did tweet something the other day where I found it kind of humorous because this is how I've changed up what I do, and this is great for a trader. I mean, this is a trader's market. I saw a video, a YouTube thumbnail that said how the Trump trade, how to trade the Trump trade. I'm like, don't click on it. Just basically intraday trade. You just intraday trade, go home flat, and don't even bother clicking on that video. And I said, you're welcome. And that's really what it is.
It's a great point, though, because, obviously volatility has subsided now in various markets. FX vols are still a little bit higher, but equity vols have come down a bit to 15% or so if you look at the VIX. But it's still pretty hard to carry risk over, when you're not in front of the screens and not able to react to news, because, the news that does come out can cause some pretty big rips in markets. And obviously that pays into your risk management. Where do you place your stop, position sizing and stuff like that? But of course, can you go to sleep and have positions on? I mean, that's a big talking point amongst traders at the moment.
It is. And, JD Vance actually said in a news conference yesterday, I'm going to paraphrase, but he's like, if you think that we've gone hard the last couple of weeks, it's going to be like this for the next 4 years. And it is going to be tough. The dust will settle to a certain extent, but remember, we're all about tape bombs at this point, and probably will be for the next 4 years.
Well, I think it's worth going into. Let's go into topical thunder, because one of the things I want to explore is this idea about becoming somewhat desensitized, or having a bit sort of headline fatigue. And so I think it's probably worth having a look at that now. Let's go into topical thunder. Let's go into sentiment, Blake. I want to take a little pulse check because last Monday markets got, we saw vols come alive with the deep seat news. This Monday we came in and we're all trying to, we saw the executive orders being placed on tariffs, and obviously because they were put on hold in the case of Mexico and Canada. China's tariffs have kicked in, they responded, but it seems like the market's saying, well, maybe we are seeing the tariffs have been fairly targeted, and perhaps they were less onerous than some people have been anticipating. The moves from the PBOC to have a far stronger fixing suggests that the PBOC are in no mood to be taking on the Trump administration in a currency war, and maybe that's just a pill. But look, we've got the DAX and Euro stocks pushing new all-time highs. ASX looks okay. We've got US equity indices looking okay. Vols have come down a bit, as I say. Rep and participation is not great in equity markets. Crypto's not ripping at the moment, and the dollar's selling off So how are you seeing sentiment? I've been adding a little bit of risk recently, but we're still cognizant that there is still a headline risk hanging over markets here.
Yeah, I think that's the point. Is there's going to be headline risk all the time, especially when you talk about Europe. Euro is a great example. I mean, the euro, taking a step back, they're going to be in the crosshairs soon, and we could be a day, 2 weeks, a week, a month away from getting some nice European tariff headlines. But for right now, I mean, everybody's looking at like the Canadian and the Mexican situation. They're like, oh, look, his bark is not as his bite is not as bad as his bark. But I made this comment, and I made this argument in our community today, is that I think the Trump administration is going to be a little bit friendlier to our neighbors, and they're going to be a little easier with Mexico and Canada, just because they are our neighbors. But you start looking abroad, and whether it's China or whether Europe, I would not be expecting the same type of treatment. And I think President Trump has felt over his previous and probably even post his last presidency, in his last term, I think he feels a little flogged. I'm going to use your term, flogged by the European leaders out there, and maybe a little dismissed. So I think he's going to come out swinging, and that's the headline risk. For now, you're right. I think everybody's like, oh, everything's fine. Markets are, risk is taking off again. We're near our all-time highs in the S&P. But I would be careful letting your guard completely down. I mean, I've been playing that too. I mean, I've been playing the dollar on the short side, but there's always a risk out there, Chris.
Always a risk, exactly. But yeah, I mean, you talk about them being your neighbours. Well, they might not be your neighbours going forward in the future. They may be the 51st state, but we'll see what happens with that. Obviously, that's a very, very not going to happen. But yeah, look, I think China's still the elephant in the room for me. I mean, I think we've been seeing signs that the EU and the US may want to get on, and they could come to some sort of agreement. But yeah, I mean, I think the China thing still is one that, because there's still a lot of people within the close Trump administration who are stringent China hawks. And yeah, we'll have to see. I think, and of course, we've got to see what happens with Mexico and Canada. They've had their tariffs haven't been cancelled; they're just been delayed, so that could come back into the market's foresight again.
That's great, and that's right, Chris. And I'll tell you that those currencies are going to end up coming into play for us over the next couple of weeks. So make sure you guys are always tuned into the week to the trade-off video here every single week. Let's shift our attention to stocks, because as you pointed out, stock market's been climbing. Volatility has been dropping. Earnings, frankly, they're not that bad. But even the companies that are getting hit, you could take like last night, AMD stock got hit after earnings, even though it bid up post close and post earnings, it quickly reversed and broke down below a wedge. Google was down quite a bit intraday. But what we're seeing is we're seeing a lot of rotation in the markets, and it's keeping the market pretty well elevated. I mean, again, the S&P is above 6,000. We're above 6050 as we speak, and just a hop, skip, and a jump away from highs. You have VIX that's selling off, and I think a lot of people were looking at this quarter's earnings as very, very pivotal. But frankly, it hasn't been bad. It hasn't been horrible. And like I said, there's a few pockets out there. But then you take the Plantiers of the world, that are up 20%, on AI news post earnings, and it just reinvigorates everybody else and their opinions of where we're going. So, Chris, from your point of view, looking at the equity markets and the U.S. equity markets, I know we tend to focus on those a lot, but you're going to be focusing on even other markets other than U.S. today.
Sure.
But generally speaking, bids, the risk is very well bid. How are you seeing the markets and earnings and rotation right now?
Yeah, rotation was a theme last year, and it's a theme this year as well. I mean, earnings are fine. They're good. I mean, 77% of companies have reported, but just over 40% of the S&P have reported, and 77 big, which have beaten expectations, a little bit less on the sales number, but that's in line with sort of the long-running average. But yeah, I mean, look, obviously we're waiting for NVIDIA's numbers. They come out on the 26th of February, and we're expecting some good numbers from them. I think what we saw with AMD was that the data centers were a little bit underwhelming, and that probably plays into the idea that Nvidia is still they maybe sort of pushing out the race a little bit, and that sort of reinforces the idea that Nvidia are still your best play if you want to go into the GPU world and the data center world. So yeah, we've seen a nice rally there, and I wouldn't be surprised if we saw a little bit move. But yeah, I mean, IBM looks great. Meta looks amazing. Alibaba looks absolutely amazing. So there are some stocks which are ripping at the moment in strong trends. But yeah, we are seeing that rotation coming through. But yeah, I think right now, where do I see the balance of risk for DM equities? Higher is the bottom line. I think the market is fatigued on tariffs. They've said, well, we've probably heard enough now to say it's a risk, but we probably feel we can move on and we try and get into what we do best as traders, and that's price risk around data, central bank decisions, that sort of stuff. And with tariffs, we're trying to move away from it. We're trying as best as we can and that allows us to focus on all these factors. So yeah, I think we go into new all-time highs. I'm probably giving it the kiss of death now, but I think we go into new all-time highs in the S&P. We're not a million miles away from there, so it's not hardly a big call. I think we go to new all-time highs and stay long. Euro stocks, DAX, European equity markets. I think the ASX 200, the AUS 200 has been climbing since December in a beautiful way, in a beautiful bull channel. We're making higher highs and higher lows. We're coming into earnings season here. I think that looks really good as well. It's a slow grind. It's more of a value market, so you don't get that explosive move like you would do in the DAX or the Nikkei or certainly the Nasdaq. But I think that goes higher as well. So right now, short term, I like these markets higher. I think that's where the balance of risk goes. And I'm going to flip it back to you, Blake, because obviously one of the big talking points at the moment is around gold. We've got our gold all-time highs, but it's also the US dollar. And it sort of feeds a nice way into the next section, which is the NFPs. But for now, let's focus on the dollar, because dollar index is firmly below 108. We have seen yields moving down on the 10-year down to 442, and that's helped. And we saw a slightly lower JOLTS number. We saw a slightly below consensus ISM service number. But I don't think that, for me, I think that's part of the reason we're there. But I think for me, part of the reason is also dollar CNH, the offshore yuan. I think a lot of macro funds had got long the pair, thinking that the PBOC, once they had tariffs, which of course have evolved to an extent, would look to have a prolonged depreciation of the yuan. And that hasn't happened. Yesterday, we saw the fixing coming in from the PBOC. It was much stronger than expected. And it showed us a message that the PBOC do not want to engage in a currency war. So those dollar CNH positions came down. I think those dollar flows resonated in dollar selling across the board. And I think people had got long the dollar on the whole tariff situation that was going to cause significant disruptions. And again, that doesn't seem to be happening with the equity markets pushing higher. So I think those dollar flows have just seen a repositioning coming through, and we're down. But obviously, we've got payrolls tomorrow for us. So do you think that the dollar's got further downside here, or take a more neutral view? Do you think we flip it? How are you trading the dollar, and which pairs are you looking at?
I do. Technically speaking, I mean, the fact that we just created a lower high longer term, I'm very, very bearish the dollar. You're going to see in some of these setups that we have.
Yeah.
I know you guys, I'm kind of giving it away a little bit, but I mean, the breakdown in yields, that, by the way, that is an inverted head and shoulder pattern. If you're looking at the 10-year notes market, the fact of that we're starting to see a little bit weaker data. And I actually think the jobs data might start to show some signs of weakness, because you saw the private sector numbers come in, and they were good. They were in line basically. But I feel that the government, you're going to see a lot of jobs shed quite a bit and moving forward. And I don't know if the private sector is going to be able to pick up the slack. And so as a result, I think you're going to start to, and when you talk about labor market, you start to see numbers shift, whether it's this month or it's in the coming months. It's kind of like the inflation genie. You have business leaders that are looking at the jobs numbers every month. They're, small business owners, people like myself, to people that, people that actually run companies that are in the S&P 500. And, if you start to see the jobs market turn a little sour, you might be a little bit more hesitant on hiring. If you were going to hire, you might be thinking, and it might need to trim some fat around here too. So that type of sentiment may start to leak into the market a little bit. But overall, I think the dollar is set for a sell-off, especially if we break below 107 in the dollar index.
I like selling rallies. I'll be staying out. We'll talk about the NFP in a second, but I think Scott Besson's comments that's just come out, saying that he's not putting pressure on the Fed to cut rates because he says he doesn't need to. And he's very focused on the 10-year Treasury. But I think he's saying, with lower spending coming through, and spending has been such an important part of the non-farm payrolls. 70% of jobs were created through government spending in 2024. If they're going to lower spending, obviously pulling out his threes and trying to lower the deficit, that's been a big significant lever of support. He's saying that they don't need to cut rates because we're going to see the disinflationary pressures coming through from lower spending, and that will pull down yields. And I think that's a fair thing. So we're going to see we will see lower payrolls this year, not just because of lower spending, but because of what Doge's influence and the immigration policy, of course. I agree. I think, but where do you go? In terms of the dollar selling, well, we'd need to see China really coming, and I think we need to see a situation where the rest of the world growth has troughed and actually looks relatively better. So. Yeah, I think there are signs. I'm a seller of dollars. Of dollar rallies is my call right now.
Well, let's talk specifics then. Let's jump in the last topic and let's talk about the non-farm payroll. And as we're actually just kind of digging into this right now, and I agree with you exactly what you're saying here as far as Doge goes. I just hope they can complete the freeway, the expressway next to my home. I hope they finish that off before they cut those jobs. Right. And I'm sure there's a lot of people in the United States that feel the same way about different places that I've been all throughout the United States over the last couple of years.
Last time I drove down the LA freeway was about 7 years ago. It was potholes everywhere. It was a dump.
And they tried to fix those over the last several years, but I'm sure, like every metro around here, there's a lot of construction going on. But eventually, you're going to start to see those jobs go away. And when you're talking about what are you going to focus on? And this is, I kind of want to talk about the playbook here, and then I want to get your opinions on what you're thinking. We saw a significant breakdown in the dollar yen. We saw it for a couple of reasons, and I know we're going to be focusing on this technically. But when you're talking about a country like Japan that has, that I don't want to say they're shielded from tariffs, but I think the relationship between, Japan and the U.S. is a little bit better than other places around the world. You got a drop in yields. I think the dollar yen is going to be extra sensitive to a downside print in the non-farm payroll. So if we do have a jobs report that comes in weaker than expected, I am actually looking to focus on the dollar yen. What pair, I probably just stole your thunder there, but what pair or pairs would you be focused on with jobs, and how do you feel about the jobs report upcoming?
Yeah, I think it's a difficult one. I mean, the Fed have the Fed have made it. I think the market's saying that the Fed are probably much more closely focused on inflation than the jobs number. And we've got to remember that if you go back to the last 5 years, that we've seen these really big outlier numbers in January for whatever reason, seasonal numbers. So yeah, we've got to take that with a pinch of salt. So the sort of average gains we've seen in January over the last 5 years have been something like just over 320,000 or so. So we've got to take the view that for whatever reason, there does seem to be a bit of hiring come through. So we may have to look at it on a seasonally adjusted basis. But yeah, 170,000 is the consensus call, 4.1% on the unemployment rate. Dollar yen, I think you've got to look at dollar yen because, you are seeing a situation now where the yen is starting to look pretty perky. We've seen those wage data. I think the market's underpricing the terminal rate for the Bank of Japan. But you've started to get momentum working for me. You talk about fundamentals. But for me, the market's telling you that they're seeing something a little bit more attractive in the yen right now, and I think that we've got to be looking at the yen in that situation. So, yeah, I think it's a messy read because, as I say, there's all these seasonal factors that play into the January number. So I think you're probably going to look at the unemployment rate as probably your most important metric. So yeah, I mean, if we get a number, say 4.3, then yeah, I think dollar yen goes downtown pretty hard. Obviously, but the risk is we get a big hiring number on the household survey, and we'll see what happens there. So yeah, I think dollar yen's the one everyone's focused on. But yeah, I mean, obviously you got something like Aussie dollar, Kiwi dollar, and that may look more at the reaction in the equity market. So if we see a number that the market says, hang on, this doesn't really do too much to rates. It's a good number, it's a healthy number, the economy's strong. You see the equity market pushed in all-time highs, and you may well see a situation then where the Aussie dollar and risk FX rallies, but yeah, dollar yen goes down. So we'll see what happens.
I think we're done.
We're done. let's move into the charts. Let's go to that's the setup. All right, let's bring up the charts. Let's talk techs. I'm going to bring up gold. You can't get past gold right now. It is the flavour du jour at the moment. And, we can talk fundamentally about why this is happening, whether it's tariff related and people looking to hedge. I mean, obviously, everyone's focused on the physical market at the moment. You're seeing, the futures curve going to deeper backwardation. You're seeing lease rates really spike up, funding rates, all these stories about Bank of England, people selling out at discounts, but there's an incredible tightness in the underlying physical market at the moment, which is pushing the spot price up at the moment. So that's not necessarily going to go and go away any time, and you can see why it's driving our spot price up to it got up to 28.80, and it's come back a little bit here. I think the sort of general view, Blake, I'm seeing now is that this is hot, and it deserves to be hot. It's you can see it holding above that 5-day exponential moving average. And if I was long, I'm not long, but if I was, I would be holding that long positions right now and just looking to trail those longs and close out and look to mitigate on a daily close below that 5-day exponential moving average. I think the trade is, though, to buy pullbacks into that 20-day moving average, which is the black line you can see there. But it's got hot. It's got so hot that it's hard to chase here. I wouldn't be putting new money to work here. I'll be waiting for that pullback and looking to buy in as a sort of swing strategy more than anything else. We've seen a lot of client interest now looking to short at these levels, just saying the risk rewards has skewed and changed, just aggressive, in and out sort of positions. But it's too hot to chase. I'd be waiting for a pullback. But you can see in the physical market, lease rates, all these funding rates, all the storylines is that this is a very, very hot market. Demand's there. Bullion banks are scrambling for whatever gold they can get. And I think it deserves to be where it is at the moment. So pullbacks are a buying opportunity within this bull trend at the moment.
Yeah, it's a big bull breakout. I mean, while it's above 2,800, you can't, I don't know how you short it. But, Chris, I just need to mention this. I think we talked about this in the fall, back in October, when the gold found its intermediate top around then. It's like I have a hard time arguing the bearish side of gold. And when I feel that way, I feel that the market might be a little one-sided, but that doesn't mean I'm trading it. I'm not trading it anyway. It's just super bullish technically.
Yeah, I just wouldn't even try and understand the fundamentals because they're just there's. Gold does what it wants to do. I mean, we're not hearing all this central bank buying. The Turkish central bank are buying, significant amounts of gold, and so it's central bank buying. It's the physical market, but then everyone starts talking dollar weakness, real rates, that sort of story, and that's conflicting. So, for me, when you're trading gold, just look at the aggregation of flows, trade the price.
Well, speaking of what they're selling, let's take a look at the dollar Swiss, Chris. The dollar quiz, dollar quiz. Yep. The dollar Swiss is one of my setups here as yields start to break down on the 10-year. The dollar Swiss tends to be a yield sensitive currency, but what you'll see is we're on its big channel support. It's the 50 DMA is that orange squiggly line that you see there. That's a 50 DMA. The red one is the 200 DMA down below. But what we also forged out is a potential double top, especially if we start breaking below it's 89.50, 89.60. That's where that red line is down below the current price. I think this is going to be very sensitive into the non-farm payroll. I wouldn't be surprised if you find some buying here near term. But if we start getting below 90 cents and definitely below 89.50, you have a big double top that points us a lot lower than that 200 DMA. I think it's a good setup because if you're bullish the dollar and you're like, I'm not buying this dollar weakness, I'm not buying the fact that the dollar is weak, your risk reward is very well defined here. And that's, as traders, that's what we try to identify as the best risk opportunities with the littlest reward. And I think this is a very big pivot for this potential pair.
Yeah, I like it. It's a good setup. We'll have to see, needs a bit of work in my opinion, but when it does, I think that will force the hand. And then the other one is a similar sort of vibe. Is dollar yen, which is the setup that I want to focus on now, which is coming. There it is. It's obviously a different setup, but what we're seeing now is the sellers are obviously in control at this stage. I mean, you were seeing it obviously making lower lows and lower highs, and it's grinding lower. We saw a bit of an expansion in range on the session that was. So, right now the probability is this has probably got, that this could fall, and then I'd probably, as I say, I think there'll be a chance for this probably to fall a little bit lower, and then I think people will look to tactically flip those positions and cover those shorts going into payrolls, because as I say, there is a prospect that seasonally in January you do get these strong numbers. I think the payrolls numbers itself, going back to that point, is probably less of a volatility event than we've seen in some years, because we'll look through the numbers and see how it plays in. But I think I'll be looking to sell rallies in dollar yen on this situation. So I'd be expecting a little bit lower, following that trend. And then what we could see on the Friday session going into going to payrolls is people looking to cover, and that could push it up. So there could be some tactical intraday opportunities there. But until we can see a convincing close back above that 5-day exponential moving average, which you can see is capping the rallies, I think people will be looking to sell rallies, and I think that's the trade that I'm seeing from this daily here.
Well, then I'm going to double down on your dollar yen play, because I agree with everything you just said.
Thanks, mate.
And I'm going to bring you your last setup, or the last setup is the euro yen. We've been looking at this triangle consolidation, and obviously the euro yen's coming into some really, really critical support. If you're looking at our harmonics pattern, this would actually be a Gartley support, but the flip side to that is if we break through those lows, we break through that triangle support, which is the 78% retracement. Basically, we start getting much below 158. Then you're talking about a harmonic pattern that can actually turn into a butterfly, which would actually take us all the way back down sub 154 on any extension below. And as Chris mentioned, there's a lot of things driving the yen right now. The wages numbers that we got last night or yesterday out here in Asian trade, the breakdown in the dollar, in the US 10s and yields, that's weighing on the dollar yen. So it's just helping yen along. And then euro, you talk about the Eurozone, we are a hop, skip, and a jump away from, getting tariffs slapped in the Eurozone. Don't think, if you're in the Eurozone, you're getting away with anything, because Donald Trump's going to be coming for you, and the Trump administration is going to be coming for you as well. So the euro yen is going to be, feeling some downside pressure, especially if the dollar yen continues to break down, as Chris thinks, and I happen to agree with. So that's why I think a triangle breakdown, we're poised to drop back below 154 and quite possibly even lower than that. Yeah,
great setup, worth putting on the radar. We'll see how it trades going forward. Anyway, let's go to play of the day and see what's front of mind there. Well, I don't think it's going to surprise anyone too much that I've been pretty vocal in where I'm seeing the risk at the moment, and that's in the equity markets. I mean, I think there's dollar downside. I'll be buying pullbacks in gold, and I still think there's a good range to be trading in some of the cryptos, for example, certainly Bitcoin. But for me, I'm looking at the Germany 40. The charts shows you, below 21,200. We've seen those two candles, long wicks, really strong bids coming back into the market. The market's very happy to support there. Obviously, we know that's where our risk is. But after that buying was absorbed, and it absorbed it so well within the deep seat news and the headline risk coming out around tariffs. The market just showed you that they wanted. There was really good bids hanging below those levels, and we pushed it up. Then we saw a higher high. A little bit of indecisive, and then we've seen follow through buying there as well. So I'm long the pair. I'm long the index. I think it goes up. I'd be looking to close on a daily close below 21,200. I don't have a limit or profit target on that. I just want to let it kick, see how it goes, and then I'll be looking to ride it and for a close below the 5-day exponential moving average, and potentially even look to add size on this as well. So where does it go? I have no idea. I want this to kick. I want it to be an outlier in the distribution. I want it to run, and then it's the art of holding. So this looks nice. It shows really good demand. Obviously, there's risk around the headlines and stuff that still hasn't gone away, and earnings in Europe across the Euro stocks, and they're pretty good. They're coming in thick and fast at the moment. We've seen a number of big heavyweights, and again, the majority are beating. We're seeing decent earnings growth as well. So again, earnings are supporting as well as the macro. So bottom up, bottom down, and technically, I think this kicks. And obviously I've got a position, and therefore, should this go, I'm in the mix there. So I like this trade. I think it looks pretty compelling to me.
I think this has been 2 weeks in a row you've focused on the DAX. I like it, Chris.
Well, I did. What did I do last week? Ripple. I didn't get a position because it didn't break out of the the pattern I was looking for. But last week, and that's a setup. We were talking about. You were talking about the DAX, and it's worked fairly well.
Look, it's turned into a setup to the play of the day. See that evolution? I like it.
The morphing. All right.
The evolution. The evolution. Okay, so my play of the day will be the Euro New Zealand dollar. And I'm playing this. I'm going cross as I explained to you guys last week, since that's the first time we talked since the beginning of the year. I am going to be focusing a little bit more on some of these cross rates, trying to stay out of the crosshairs of the dollar. Not all the time, but a little bit more. I'm going to try to get some focus here. And what we've seen is the Euro Kiwis come down some really, really key support. We're sitting on the 50 DMA. Closing in on the 38% retracement. And what you'll notice is we have not been below the 182.40, 182.50 level. We haven't been below those levels, since back in mid-December. So if we start to see a breakdown, we start to see that Kiwi respond better. Even after the employment numbers, the Kiwi doesn't look bad. But again, putting Euro in the crosshairs of what could be coming anytime. I think there's risk that the Euro Kiwi on a breakdown below 182.40, we are looking at a move back down towards the 200 DMA near 180. So I'm actually looking to play a clean breakdown of this range. And, I know where the breakdown point is. You can see that support zone. And as soon as that's broken, the 38% retracement is gone. We'll be targeting a couple hundred pips lower. So
you know what I love about this? What I love about this is that it plays into my Germany 40 trade as well, because my trading accounts, the P&L is done in, or the account's domiciled in Aussie dollars. So obviously if Euro Kiwi's going down, Euro Aussie's probably going to go down as well. And so if your DAX trade's priced in euros and the account's balance is in Aussie dollars, then I suspect if that trade is to work, then it should also hit my trade, my DAX trade from a currency perspective as well. So that hopefully you're right. There we go. Anyway, thank you for everyone. There's a lot going on in these financial markets. What's going on with Trump? It's always, enlightening and as I say, keep an open mind about the headlines and how the market reacts to it. Not how you think it's going to react, but how the collective within the market reacts to these headlines, and ultimately, how they see this evolving, because things are moving pretty quickly. Obviously, keep a consideration about your risk management, your position sizing under these markets, and the changes that we're seeing in volatility. That risk management and position sizing should be dynamic to volatility in the market. And of course, if you've got any trades that we may have missed, or you've got any views, do leave them in the comments section. We'd love to hear from you. Blake and I will try and get to those when we can, and other people in the comments can share ideas as well. Anyway, we'll see you back next week for more of the trade-off.